Good morning. Welcome to Good to Know Talk Series, where our focus is to provide financial strategies and tax tips to help grow your business and save on taxes. Here we understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. With us this morning, we have our co-host and today's speaker, James Kong. James is a financial advisor at Edward Jones, and his office is in Kaka'ako. He works with small businesses, individuals, and families to identify their risk and develop strategies to help them reach their short, mid, and long-term goals. When he's not working, James plays competitive beach volleyball. He used to serve as volunteer assistant coach for the UH Wahine volleyball team under Dave Shoji, and currently serves on the Young Leaders Board for the Make-A-Wish Foundation, American Heart Association, and is also a board member on the Kamehameha Schools Alumni Association. And he's my trusted source for information in the industry. James, how's it going this morning? Thanks for being with me today.
Good morning, and thanks for having me.
Let's see, before I hand it over to you, just a quick note for our listeners. I know some people are still chiming in. If you have questions during the presentation, you can type them in the chat box on your screen. And at any time, you can email info@smarttaxhawaii.com if you would like more information. Let's see, so I'm gonna switch my screen over to you.
Just let me know when you can see the PowerPoint.
Yeah, let's see. Yeah, can you believe, so we have 6 weeks left in 2017. And I hope all of our business owner listeners are sitting down with their tax professional and their financial advisor to understand their tax liability for the year. Questions: are profits up? Should you buy some needed equipment to lower your tax bill? Should you contribute to a retirement plan? If so, how much should you contribute? These are questions that business owners really need to be asking now. So James, where do our listeners begin when it comes to retirement plans and just generating deductions for this year and, even looking into 2018?
Yeah, I'm going to give a quick overview to see for those that want to try to get in some deductions prior to year's end. There's going to be 3 different strategies that are still in play and allowable based on kind of a time crunch between now and year's end, and then also more proactive strategies coming up for 2018. But Janine, can you see my screen?
Yep.
Yeah. Okay, awesome. So I'm just going to keep it very high level. If anyone has any specific questions regarding your specific business, feel free to follow up with myself or Janine, and then I can give you a little bit more detailed information. But I did want to keep it high level. And so, is it too good to be true? Why does the IRS allow deductions in certain case scenarios when funding our retirement? And essentially, government is looking to have us as business owners responsibly allocate or put aside funds for retirement so they don't have to subsidize our retirement. Unfortunately, everyone will pay taxes at some point. It's really, if we're going to get the tax relief on the front end in terms of tax deductions, or if we're going to get it in the back end with tax-free distributions at retirement. So probably the first familiar with is, I want to work with Janine to determine what I can deduct today, knowing that I will most likely pay taxes later. So this would be in the form of a 401k plan, a profit sharing plan, your personal traditional IRA, TSP plan for federal work, SA for DOE. So the benefit there is that it reduces your taxable income today, so it generates that deduction. It also grows tax deferred, and if there's, if you folks aren't, investment savvy, that essentially means that any growth along the way, you're not paying taxes or gains on that growth from the investments. Main consideration is just understanding that you're getting a tax break up front or today, but will be taxable as income at retirement. And it's important to sit down with Janine or your tax professional, because that is going to come into play when determining how much of your Social Security benefit is going to be taxable. Okay, it could be up to 85%. Okay, so for some of you visual learners, take the business or you take the individual, we create that investment vehicle, whether it's a 401k, profit sharing, traditional IRA, TSP. And the funds that are flowing into that retirement plan is going to be tax deductible. Okay, so if net income is 100,000 or adjusted gross income is 100,000, we put aside 10,000 towards one of these policies or plans, then it's going to be a taxable income of 90,000. Now, at distribution phase in retirement, it's going to be taxed as income. Okay, so this is probably the most common strategy. Again, getting the tax benefit today and then have to pay taxes on distributions later on. Now, the other type, which some of you may be familiar with, is, hey, you know what, based on how much I'm earning today and the likelihood that I'll earn more in the future, I'd rather pay taxes today so I can get it out tax-free later when I'm probably earning more money. So the main vehicles in which you can do this is with the Roth IRA or Roth 401k. And the benefit is that it grows tax-free and there's tax-free distributions at retirement. Okay. Very important for business owners and then high net worth individuals to consider if 401k plan is appropriate for you and your business to add a Roth 401k provision. So this will allow you to contribute into a Roth in which you normally wouldn't be able to due to income thresholds. So I think that's what we're seeing a lot of business owners do is say, hey, James and Janine, I'm putting aside, money I'm getting a tax deduction today, but I know it's going to be taxable at retirement. I want to put aside into a 401k, which is going to be post-tax dollars, but it's going to come out tax-free at retirement. Okay. So considerations mainly just understanding that you are going to be funding it with post-tax dollars. Okay. And so just visually looking at it, you look at the individual and then you have that Roth IRA, 401k. You understand that it's going to be funded with post-tax dollars, but based on where tax rates are today, and then the likelihood that all of us will be earning more in the latter stages of our life prior to retirement, it's going to come out tax-free. So you want to sit down with Janine and just be sure to diversify your retirement income stream and just make sure it's not all taxable at retirement. Okay. So 3 strategies for those that may be under the gun, bought additional equipment, and we want to kind of put aside a retirement nest egg for yourself prior to 2017 and generate additional deductions. So the SEP IRA, you folks may be familiar with. It's gonna anything that's contributed to the SEP IRA, it's gonna be a tax deduction for the business. And similar to the 401k, the traditional IRA, it's going to grow tax deferred. The big consideration is that there needs to be an equal percentage that's allocated to all employees. So this is huge. And that if you have, when you started your business, you set up a SEP IRA, and now you have employees that are on payroll, I would consider switching the plan because whatever percentage you as the business owner allocates to yourself, you will need to allocate that same percentage to every single employee. So, what myself and Janine do is we like to maximize the benefits paid out to key employees or business owners, not in a bad way, but minimize what we need to put aside for discriminatory purposes. Okay. Again, it's 100% employer funded, so that
James, I think we lost you, or am I the only one? Sorry for our listeners. James, are you still? I think we lost your screen. Sorry, I apologize. We're trying to get this back up. Okay. Oh, James, James' internet just went down, so sorry about that. I think the key when we're looking at just retirement plans is planning. As business owners, you don't have to be at the mercy of every April 15th just sort of seeing where the chips fall with your tax liability. And that's why it's important to be working with your tax professional throughout the year to see what your liability is, whether it's in the current year or if there's some significant changes coming up, then we can determine what your tax liability is going to be at retirement or 5-10 years down the road. So we can make the adjustments because at times it just might not be worth taking the tax deduction in a current year if that means you're going to pay a lot more taxes in the future. Let's see, sorry, I'm getting some messages from James. So next week, I will be going over the different type of business entities. So James will, hopefully he'll be able to get through, the retirement plans. But next week, I'll be talking about just the pros and cons of, going with an S Corp or a C Corp and an LLC, just what the difference is, because the different entity structures do make a difference on the type of retirement plans that you can set up, how much you can contribute, and, just different factors to consider. So next week, we're going to stay on the topic of maximizing your deduction. So hopefully you can join us next week. Let's see. Let me see if... Okay. James is going to call back in. Is there, this might be a time for me to take some questions. If there's anyone on the call that has some questions. I know we didn't have a chance to get into James's presentation. If you have any questions, you can type it in your chat box on the screen. We also, in two weeks, possibly 3 weeks, we are keeping an eye on the tax reform that's happening, on Capitol Hill. So we will have an update as soon as, there's a vote expected right after Thanksgiving. So we are keeping an eye on that, and we will do a special session just on the changes that comes out of that vote. So we'll keep you posted on that. Okay, well, unfortunately, it looks like James is not going to be able to get back on. um, okay. Are there any of our listeners who are already contributing to SEPs and 401ks with their business? Oh, I see two of you. And James didn't have a chance to get into it, but there are, if you're in a situation where you want to be able to contribute more than what the 401k and SEP, what those contribution limits are. If you would like to contribute even more, there are, he was going to go into defined benefit plans. And these are plans where you can contribute significantly more to generate the deduction. And some of the plans, you do need to be a specific type of entity. You need to be a corporation in order to contribute to these plans. Let's see.
Hello?
Oh, hi, James.
Yeah,
Welcome
sorry.
back.
Our system's down, and because I couldn't access my email, I had to get it through my phone. So I apologize, everyone, that we kind of went MIA. But did you want me to go through the rest of it, Janine, and then we can get the slides to everyone?
Yeah. If so, I just I was just talking about how next week I'm going to go into the different type of entities, and even we're going to go into defined benefit plans. If they find that they need to contribute more to their retirement plans. But yeah, if you want to kind of go through the rest of it, and then we can
wrap this up just to be efficient with everyone's time. And I apologize that our networking system went down, but 2017, an owner can essentially bonus out themselves and employees by year's end. It's a little bit more favorable than a SEP contribution. Same percentage across the board. And it's discretionary funding, so there's no obligation year over year for that business owner to do the profit sharing plan. So depending upon cash flow, they can determine, he or she can determine if there wants to be a bonus paid out that year. So any profit sharing bonuses is tax deductible for the business. And then consideration is just going to reduce the company's cash flow and then have to include all employees. Again, it will be more favorable than a SEP IRA contribution because the benefits, again, the advisor will try to skew the benefits to the business owner. There can be a vesting schedule. So employer contributions, the business owner can state a certain vesting schedule so that if the employee were to leave, then they may not be fully vested in what was put aside for them. It needs to be ran through payroll, so it needs to go through by year's end. Okay. The third strategy, which myself and Janine are seeing a little bit more common, is called an executive bonus plan strategy. And so this, in this strategy, the owner can select and choose which employees to include and exclude from the bonus. So it can be discriminatory in a good way. So the bonus is going to be funded to fund a cash value life insurance policy, or it can be to fund a long-term care policy for any key employees, the owner, or whoever it may be. Okay. Similar to profit sharing is that it is discretionary funded. So depending upon cash flows or owner's desire, they can pick and choose when to do bonus. it can be discriminatory in a good way, because I see this a lot of times in family businesses where they just want to bonus out the spouse and the kids that are working and exclude all other employees. Professional services, whether it's doctors, dentists, attorneys, where there's going to be a large gap between those that serve key roles in the business and then maybe those that are just administrative. Okay. Consideration similar to the profit sharing, it's going to reduce the company's cash flow. And the deadline is similar to profit sharing, is that it needs to be ran through payroll. Setting up a strategy for 2018, and just to give all business owners that are tuned in an idea of, hey, from a high level, what plan is going to be most suitable for me. So for a SEP IRA, I would say any kind of infant in their infant stages, that there's just either single employee or there's family employees, simply because if you're looking to deduct or contribute 25% of your income, it's going to have to be 25% across the board. Okay. You can deduct up to $54,000 or up to $60,000, depending upon if you're older than 50. You get an additional $6,000. $54,000. Main considerations, again, if you don't have any family employees, or if you don't mind that you're going to be contributing for yourself, I would probably recommend to stay away from the SEP IRA, or maybe transition into and as you next strategy, simple IRA. So these would be small businesses with employees. Okay. And from the deduction standpoint, owner is looking to deduct anywhere from 18 to 24,000. Okay. So it may again be a business is in its infant stage where there may not be, free cash flow, in which they're just looking at deducting that range of 18 to 24,000. Okay. Main difference is that employees can participate in the plan. So a simple IRA is going to be like a smaller 401k. So employees will have skin in the game, and business owners can determine if they want to offer a matching contribution. So with a simple IRA, if the employee chooses not to participate, the employer does not have to contribute to their plan. So I think that's pretty valuable, because, it shows that if the employee doesn't have any skin in the game, then, the employer doesn't have to contribute to that plan. Okay. The next is 401k profit sharing.
James, I wanted to just add that, I think the common question I get is business owners think they have to have a big business in order to set up these plans. They have to be a major corporation, or they need to be, making, over $1 million. They just think of this as big business. And, that's not true. You don't have, there's no minimum in terms of your income or profits in order to set up these retirement plans. I just wanted to mention that.
Yeah, and I think it's really sitting down and determining, how we're going to balance off immediate cash needs, and then also future cash needs in the form of a retirement nest egg, and then also trying to wash out or reduce the amount that has to be paid in taxes to the IRS. So, yeah, I think it's really looking at the tax benefit, and then you as business owners need to develop, an exit strategy. So, we're going to get the tax deduction on the front end, and then it's going to create that retirement nest egg for exit planning strategies later on down the road. And so, okay, we're back on. So can you see my screen now?
Mm-hmm. Yep, we can see.
Okay, got it. Okay, so in a 401k profit sharing with salary deferrals, so that means month-to-month contribution. It could be in the range of 18 to 24,000 with the 401k, and then if you add on the layer of profit sharing, you can contribute additional or deduct an additional 84,000. Okay. Considerations, employees can participate in the plan, and then employers can offer a matching contribution. Profit sharing is discretionary, so it's not required each year. It's just dependent upon if the owner wants to bonus out. And then all employees need to be included, but the benefit can be skewed to the business owner. Lastly, there is a third-party administrator involved, and I don't want to get everyone too confused, but essentially, they're going to help regulate the funding that goes into the 401k plan, which takes a lot of that headache off of your plate. So Janine and myself know some local TPAs or third-party administrators that may be able to help you with the funding of the plan. Okay. And then lastly, executive bonus plans. This could be a business with or without employees, and the owner wants to discriminate and bonus specific employees. Oftentimes it's key persons, whether you want to just bonus out partners in the business, CFO, CEO, COO, or just family members. So we can pick and choose who's going to receive that bonus. But it is going to be 100% employer funded. And then because it's a strategy to either fund a cash value life insurance policy that's going to produce more tax efficient income at retirement, there is underwriting required to qualify for the strategy. Okay. And so just kind of an overview, look to generate business deductions. We're going to pay taxes on the front end, we're going to pay taxes on the back end, but try to maximize the benefits that are either going to be paid out to you as the owner or to those that you value in your business while minimizing taxes paid to the IRS. You see a lot of businesses stay competitive and almost, sometimes take employees from other competing companies because, employees look at the 401k, the profit sharing plan, as a way for the business to help them build their retirement nest egg. So it's a real good perk for businesses to either reward, recruit, or retain key employees. And then really it comes down to examining cash flows. In the past 2 episodes we talked about that 3-bucket strategy. You really want to determine what the immediate cash needs, maybe 6 to 12 months that you want to keep sitting in cash in your checking and savings account, and then your midterm goals that need to try to keep pace with inflation or your specific business risk, and then long-term goals in which we realize that only when we're getting in excess of 3%, which is inflation, is your money actually working for you. And then lastly, we're just looking to reposition the business's cash flow to help fund your retirement nest egg as an exit strategy while reducing the amount that is going to be paid to the IRS and taxes. Okay. So here's my contact information because Janine's a contact. I'll be more than happy to offer complimentary reviews to see what plan may fit best for your company and then determine, the benefits and considerations of each.
Great, yeah, thank you for that. And I, you weren't on the call, but I just want to emphasize again, just the planning, and that you don't have to be at the mercy of, April 15th and, just how the chips fall, so to speak, in understanding, what your tax liability is. We can make adjustments now either for your current tax liability or for your tax liability down the road. So please, sit down with me or sit down with James so we can look into this for you. And we went a little bit over on our time. So thank you for sticking with us. We're at the end of our time. So if you, if you want any more information about today's topic, you can email us at info@smarttaxhawaii.com. And you can also, we can send you James's contact information too. Let's see, I think that's it. Thank you, James, for joining us this morning. And
yeah, sorry for the technical difficulties. Yeah.
Yeah, no worries. Yeah, it happens. Yeah, we look forward to next week, same time, same place. Wishing everyone a happy Thanksgiving, and we'll see you next time.
Okay. Thank you, everyone.
Thank you.
Take care.